Hello, this is George McAllister with MCL, and I'd like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us early insights into financial markets and health plans.
Thanks, George. In this podcast, we'll review the performance of the managed care industry for the fourth quarter of 2021 and year-to-date 2022. We'll also discuss sector valuation indicators and operating trends. Triple S is no longer included in this podcast, and it brings the total companies covered to 11. On February 1st, GuideWell Holding Company, the parent of Blue Cross Blue Shield of Florida, announced the completion of the purchase of Triple S for $36 per share. As always, we will use comparable plans and trends, and that convention will be used in the body of this presentation. First, I want to speak to stock prices and valuation for all the plans, that is, including the 5 new plans for 2021. As of March 3rd, stock prices for the publicly traded plans are lower by an average of 12.1% since the beginning of the year. Similarly, health plan sector market capitalization decreased by 2.2% year-to-date. The overall decrease stemmed from a broad decline among plans that went public in 2021. This compares to the 8.4% decrease in the broader market measured by the S&P 500. Stock prices for 8 of the 11 plans lost ground so far this year, led by Alignment at 41%, followed by Clover at 37%, Bright at 36%. Oscar decreased by 13%, Humana by 6%, and Innovage by 4%. United Health was lower by 3%, and Molina by 1%. Cigna increased by 4%, Centene by 3%, and Anthem increased by 1%. Valuation metrics were mostly lower since the beginning of the year, with price to trailing 12-month earnings decreasing by 10% to 23 times, price to operating earnings shrinking by 6% to 25 times, price to projected 2022 earnings was higher by 6% to 18 times. Price to sales fell by 20% to 0.68 times. Price per total member decreased by 2% to 4,300, and price per risk member declined by 3% to 6,600. Since our latest podcast in November, health plan valuation metrics were mixed. Notably, price to sales was lower by 13%. On the other hand, price per risk member and price per total member were both higher by 5% and 6% respectively. Average health plan stock prices are lower since the last podcast by 21%, with the health plan market capitalization increasing by 6.4%. The S&P 500 has fallen by 7% since November. As of March 3rd, all of the new publicly traded companies declined in value since the last podcast. Clover fell by 66%, Alignment by 64%, Bright by 54%, Innovage is lower by 46%, and Oscar by 43%. On to our review of operating trends. Before I begin, there's a reporting nuance I want to point out. All of the plans except for Innovage are on a calendar fiscal year. Innovage's fiscal year ends on June 30, 2021, and their earnings are for the second quarter of 2022, but we're referring to the earnings collectively as the fourth quarter of 2021. For the fourth quarter of 2021, combined ASO and risk membership increased by an average of 50%, while increasing by 7% in total to 148 million members. By average growth, I mean the average of every health plan's earnings growth rate. Total reflects the change in combined membership of these publicly traded plans as a whole. Fully insured risk membership increased by an average of 51%, and in total by 11% to 88.4 million people. Commercial plan insured membership increased by 5.4 million members to 57 million. Notably, among insured plans, Bright Health grew by 300% to 903,000 insured members. Also, Anthem insured membership increased by 3 million members to 19.8 million. The primary driver was an increase in Medicaid membership to 10.6 million members from 8.9 million members in the same period last year. Medicaid plans experienced an average increase of 19% and total growth of 14% to 24.3 million members. Medicare plans had an average increase of 40% and total growth of 8.2% to 7.2 million members. The proportion of total members served under self-funded ASO arrangements fell by 2.4 percentage points to 40%. On average, the plans posted a 0.6% increase for this product, and ASO membership was up by 0.6% to 59 million members. Revenues for all plans increased by 50% and in total by 14% to $156 billion for the quarter. Anthem revenue was higher by $3.7 billion to $30.8 billion. United Health was higher by $7 billion to $57.6 billion. Commercial plans increased by an average of 62% and in total by 14% to $97.7 billion. Medicaid plans reported $38.3 billion in revenues, an average increase of 27.1%, and a total increase of 17.5%. Molina posted the largest percentage gains in revenues for Medicaid plans, up by 41.3%, in part due to acquisitions over the past year. In the Medicare segment, plans reported $20.5 billion in revenues, an average increase of nearly 18%, and a total increase of 8.4%. Humana's revenue increased by $1.5 billion to $19.8 billion. Included in the $1.5 billion increase was $743 million increase in revenue due to the completed acquisition of the home health care company Kindred at Home. Premium rates for all plans increased by an average of 1.3%. Medicaid plans and commercial plans experienced an average premium growth of 4.9% and 6.2% respectively. Medicare plans premium rates increased on average by 0.6%. Note that the premium rate growth does not adjust for changes in product mix, geographic factors, or benefit design changes within the products offered by these plans. Operating earnings for the plans in the fourth quarter totaled $5.7 billion, an increase of over 100%, or by $2.9 billion. United Health, a commercial plan, had the largest dollar change in operating earnings, increasing from $3.1 billion to $4.7 billion, an increase of 54%. Average operating margins for all plans increased by 3.6 percentage points to negative 15%. This was due to the newly public plans that had negative profit margins at an average of negative 36.3%, When the newly public plans are excluded, the average profit margin was 2.8% compared to 1.5% a year prior. The health benefit ratio for all plans increased by 1.7 percentage points to 92.2%, similar to the profit margins of the newly public plans had a health benefit ratio of 99.5%, while the plans that were public during 2020 had a health benefit ratio of 86.1%. The average health benefit ratio for commercial plans was 98.4% versus 94% in the fourth quarter of 2020. The average health benefit ratio for Medicaid plans increased by 1.6 percentage points to 87.6%. Medicare plans had a decrease of 1.1 percentage points to 88.3%. It's important to consider the administrative expense ratio in terms of whether the plan has recently become public or has been public prior to 2021. When considering all plans, the administrative expense ratio was flat at 23.3%. Commercial plans reported a 22.1% administrative expense ratio, which is lower by 6.5% compared to the fourth quarter of 2020. These numbers seem high because of the effect of stock-based compensation on the newer public companies. Medicaid plans reported a decrease of 1.8 percentage points to 14%, while Medicare plans experienced a 9.0 percentage point increase to 29.4%. Excluding the recent publicly traded companies, established plans tell a different story in administrative costs. When looking solely at plans that were public prior to 2021, the average administrative expense ratio was 12.1% compared with 14%. Commercial plans had administrative expense ratio of 11.2% compared to 13.9% in the fourth quarter of 2020. And Medicare-focused Humana had an administrative expense ratio of 11% compared to about 11% last year. The Medicaid universe's ratios were unaffected by the additional plans since Centene and Molina were the only two plans in this universe both this and last year. Non-operating earnings increased by $613 million. Our calculation of non-operating income is the sum of investment earnings, income earned in non-health lines of business, less interest expenses. Medicaid plans reported a gain of $37 million for non-operating earnings compared to a loss in the prior year's quarter of $136 million. Commercial plans had an increase of $688 million to a total of $2.1 billion. Net earnings for the fourth quarter were higher for the plans compared to the fourth quarter of 2020. Net earnings increased in total by $190 million to $6.1 billion. Medicaid plans had net earnings of $696 million, up from $15 million. Medicare plans had a loss in net earnings from $243 million compared to a loss of $456 million in the fourth quarter of 2020. For the year, revenues for all plans increased by an average of 55% and in total by 13% to $711 billion. Medicaid plans reported $154 billion in revenues, an average increase of 28%, and a total increase of 18%. Commercial plans increased by an average of 113% and in total by 13% to $472 billion. Net income for 2021 improved by 9% to an industry total of $32.5 billion. Commercial plans increased in total by 14% to $27 billion. Medicaid plans increased to $2.9 billion, a total gain of 18%. Medicare plans had a net income of $2.2 billion, a decline of $1 billion from 2020. Operating income decreased by a total of $3.4 billion to $35.6 billion. Commercial plans operating income declined by $711 billion to $29.5 billion. Medicaid plans had operating income of $4 billion in 2021, a decrease in total by 3.1% from $4.1 billion in the prior year. I want to close by touching on a key environmental factor: the management of the care of members in a multi-product environment. As you may know, the Sherlock benchmarks provide tremendous granularity in cost, not only by function, but also by product. In looking at the relationship between plans' commitment to Medicaid product, we learned that organizations tend to have high focus on Medicaid, also tend to spend more on medical management for their commercial insured members. That medical management tends to be slightly higher for Medicaid than for commercial insured, perhaps reflects healthcare needs, the behavior of the member, and the environment in which they were enrolled. The higher commercial insured costs for commercial medical management is especially evident in functions in disease management expenses. That the relationship is not found in other medical management activities suggests the possibility that plans vary in their execution of medical management. Staffing ratios for the commercial insured medical management was also driven by Medicaid. And the relationship appears even stronger. The higher the commitment, the greater the staffing ratios for commercial insured medical management. Disease management staffing is also reflected in that relationship, but so too did health and wellness and utilization review. The stronger relationship when staffing rather than Pmpm costs is the independent variable, is something that we've encountered in our economies of scale studies. Compensation levels and non-labor costs can mute the effects of an independent variable on Pmpm costs. We are now gearing up for our 25th annual benchmarking studies. These provide norms for administrative costs for the 70 functional areas in numerous products, as well as the staffing ratios and numerous operational metrics. There are universes of IPS plans, Blue Cross Blue Shield plans, Medicare, Medicaid, and larger plans. At present, we have commitments from 18 Blue plans and 16 IPS plans. They collectively serve more than 6 million people, and in the case of the Blues, consist of most plans. The detailed benchmarks are available for license, or you can participate in any of these universes this year. Please let us know if this is of interest. You will be among good company. As always, you can get a transcript of these remarks through MCOL or through Sherlock Company. We look forward to hearing from you. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock shares quarterly insights into the financial markets of health.